Welcome back to another series of the Bootcamp. We're in episode 2.2 and we're slowly working our way towards the fun part. We're slowly working our way towards the real edge. And I promise you, I'm not trying to gatekeep it, but as I said in episode 1 in the introduction, I'm giving you I gave you a whole timeline about how this whole bootcamp will be structured. And this is not just a single thing that I'm just throwing online on YouTube. It's really a thing that I wanted to stand the width of time. I wanted to be there, and in case that I get new members on Discord, new members in my community, and who knows, maybe that I grow, that I can always refer people back to those videos, you know. And I think we've done good. We've gone through the basics, and we've done the introduction episode 1. We've gone through the basics episode 2.1, from candles, what tools to use, what brokers are, what prop firms are. So even the very, very, very new traders could already be using those information that I gave in episode 2.1. But now we're gonna get a bit into like the foundation of trading and how I started personally as well. I remember back in the day, 6-7 years ago, when I started trading, those were some of the key concepts that I was still using. And even though you're going to see that I don't use them specifically on their own anymore, but you will see that I still use them to a certain extent, and I still have a general knowledge about them. And I think that every trader should. And I know that I've, in the previous episode, that I really talked a lot about maybe certain things that you guys didn't find relevant, but I'm trying to keep it a bit less for today's episode. I'm just trying to get straight into the detail and see what I can do. But yeah, so the foundation. And before we start, remember, we're trying to do this as raw as possible. I'll be reading through my presentation. I've written everything down. Took me a lot of time to put everything in there. I have some charts on the right side of my screen, which I will be looking over consistently, so I remember and remind myself which charts to use as I'm going through the examples, so I could give you guys the perfect example of the trades that I've taken. And then on the left side, I got some other notes open, so you'll be seeing me. You might see a bit of a disflow, but then you know what's up. So the foundation, understanding key trading concepts. We're talking about levels, time frames, candles, entry management, and discipline. And the most important thing, I think, which I personally believe, is the levels, the time frames, and entries management. Discipline will come later down in the stages in episode 3 specifically, which will be the episode that I'll be recording after this. Let's get into it. One more thing, different trading styles. I've mentioned and I've touched upon that in episode 2.1 as well. I am an intraday trader. I'm an intraday trader that sometimes intraday swings or intraday scalps. That falls under 2 categories. Intraday swinging is when the higher time frame context, which I'll go over in a bit, matches my bias. So I'll be able to hold through pullbacks and get that massive 10R, 5R, 6R, whatever our trades. Those are my money trades, those are my home runs. But I also have my quick scalps, my intraday trades. They could be against the trend, they could be with the trend, they could be a quick VWAP reclaim, they could be anything. And those are usually base hits. And remember, base hits are as important as home runs. Base hits could pay you when the market is dead, the market is slow. Base hits could pay you consistently. Base hits helps you to build a buffer so you could size up on your home runs, on your A+ setups. So they're both very important in my trading journey. But you also got different trading characteristics. And that different characteristics of trading, that different trading style, they fall under some of the equities people that I follow. They look at the daily time frame and they take trades based on the daily time frame single-handedly. So they only consider what the daily time frame is doing. But then we have a mix of that, just so you guys know. Bit of a cough. How the market moves. As I said, we went over what makes the market move, who are the market participants, and now we're in how the market moves. Understanding market structure is fundamental to trading. While price action seems chaotic, it generally adheres to 3 identifiable trends: an uptrend, a downtrend, a sideways ranging. An uptrend, categorized by higher highs and higher lows. Prices are generally increasing as buyers are in control. Downtrend, defined by lower highs and lower lows. Prices are consistently falling as sellers dominate the market. Sideways or ranging. Prices move with a defined horizontal range, bouncing between support and resistance. That could be any level. Neither buyers nor sellers have clear control. We're in an inside day. We're chopping up. This is common for established indices consolidating. Side note, it's easy to forget the basics when your attention is consumed by strategy rather than the market itself. So I had a little thing happen to me yesterday as well when I was trading yesterday. And I want to go over and show you guys. Let's go and show you guys some charts which falls under sideways, ranging, uptrend, downtrend. So as you could see, I'm on the QQQ. This is the same as MNQ. This is the same as the NQ. Tracks the NASDAQ. And this is a daily time frame. We're on the daily time frame. So as you could see, on a higher time frame, this what we got here. Oh, that sucks. Let me see if I can do something else. Let's see. Yes. So this move up is what we call an uptrend. This move down is what we call a downtrend. We're making tops, failing to break highs, making lower highs, lower lows, lower lows, lower highs. When do we see that change in structure? When do we see that change in trend? This is where you see the change in the trend. And that's what I call the high-low, low-high strategy that I use. It's a change in trend. It indicates a change in trend. We'll go over that in episode 3 in detail with trades that I've taken on them. So this is on the daily. And the moment we break this, we start making higher highs. We start making higher lows. Uptrend, pull back, higher lows, higher highs. Pull back, higher lows. Range, uptrend, higher highs, higher lows. And every time we're making those higher highs, higher lows. What could be a choppy market? This is a sideways or ranging market. This is where we don't have clear structure. We go up and down, up and down, up and down. And we're not really necessarily making higher lows or higher highs. We're not making lower lows or lower highs. We're within this same range that we have made over the course of the past month, let's say. And this is for the daily. But this same, because price structure is fractals, the same structure happens on the lower time frame. So something that I really use a lot is a 3-minute time frame, as I've said that earlier. So what do you see? This could be considered sideways ranging. However, yesterday we had a fill of VWAP, so we reclaimed VWAP, pulled back into VWAP, and continued. And what is this? This move that we had, where we went up, pulled back a bit, went up, pulled back a bit, went up, we started creating a series of higher highs and higher lows. And what does that indicate? It's an uptrend. On the daily time frame, this might not be significant, but remember, we're intraday traders. And for us, this is considered an uptrend, This is considered an uptrend. This is considered chop, even though it only lasts 20 minutes, 30 minutes, this is considered an uptrend. This is considered an uptrend. This is considered chop. Uptrend, continuation uptrend. And this is a downtrend. So I can go over and over again, but for me, I generally don't care what the daily is doing. I don't need the market to really be ranging, trending. And as intraday traders, we don't care what the higher time frame daily is doing. What we do care about is the context we're in. So it's good to know the market brought with. Are we bullish? Are we bearish? Or are we chopping? But I don't trades based on the daily alone, where I'm like, okay, the daily is ranging, so I'm not going to be taking a trade. Because even though on the daily we could be ranging, we could be sideways ranging, intraday we could see massive upwards or downtrends that the market creates. So that's something that I really want to touch upon, that a lot of people, I don't know, they care too much about what happens on the higher time frame, on the daily chart, whereas we take trades based on the intraday chart. Because on the daily, you could be seeing this as a chop. So this is where we opened. So let's say close, high. And then this is considered a inside day on the daily time frame. However, this gave perfect opportunities on the intraday. It had a perfect upwards trending day on the intraday. So That's also something that I really want to touch upon that a lot of people have big misconceptions about. And then let's see. We're going to get into support and resistance. And I feel like support and resistance, you could call them liquidity levels, you could call them zones, you could call them lines. Some people call them liquid levels, so where price needs to go because there's a lot of liquidity. And usually how support and resistance work is there are places where a lot of orders are stacking, where bits are being stacked up, where asks are being stacked up, where people are hoping to sell there because they come into a key level or whatever. Let's read it. So higher time frame levels. Higher time frame levels are the strongest and most important because they've usually been tested many times. The higher the time frame, the stronger the level. The biggest moves always start from there. Intraday levels, which I significantly use. Intraday levels form within the same day and are smaller but still meaningful. Your base hits come from there. They're great for scalp trades and short-term reactions, but they don't carry the strength of higher time frame zones. And this is what separates my home runs from my base hits. Keep that in mind, very important. React, don't predict. Don't enter a trade just because price reached a level. Wait to see how it reacts. If the reaction aligns with your entry model, then you take the trade. I'll show you an example of that as well. Let confirmation guide you, not prediction. We're not in the business of predictions. We're not in the business of betting, gambling. We're not predicting things. We're taking action after something happens. We're reacting to them. We're not taking action before it happens, which you could do, and I'll get that in episode 3 in the advanced sectors, where you could be predicting by having some starter sizes into your trade and then adding on the confirmation where you're reacting to that confirmation. But then that's something that's a bit more advanced, which I'll get later on in the episodes. So let me open the charts. This is where the fun part got. I remember 21 October, I think it was in October, where we had in gold setting up with 3 consecutive gaps. And I, considering 2025, I only traded gold 6 times. This whole year, only 6 times. And I really don't touch gold. I don't like trading metals. I don't like trading commodities. And considering that gold was up that much, I had to take action. I also wanted a piece of the profits that created such wild ranges, let's put it that way. And one thing which I realized was that gold had a multi-gap setup. And let's get into gold. And for gold, I use the GLD, which is the equities version of gold. So GLD. And then we're gonna go to the daily time frame, and then we're gonna go into, let's see. Yes, it was the 21st of October and the 19th of October. 15th, 17, 21, 2, 3, and also 9 October, yes. You could see that I didn't participate in any of this. So didn't participate in this, didn't participate in this upward move, didn't participate in this. Where I started participating is we had 1 gap up, 2 gap up, 3 gap ups. And I shorted this day. And then we had 1 gap up, 2 gap up, 1 gap up, 2 gap up, 3 gap up, shorted this day, and a break of yesterday low, shorted this day. You could see that I was able to be in this huge red candle to short, this huge red candle to short, and this huge red candle to short. And in this whole upward move, those 3 days were the biggest gainers for if you were shorting. And I was in there. And it isn't luck. It wasn't luck. I didn't touch anything else because I was waiting for that 3-day gap setup. And I'll get into that in episode 3. But I think it's nice to show you that the difference between higher time frame levels and lower time frame levels. So a setup like this is what I call a high time frame level. That's where my home runs comes. This is where I make a lot of money because it comes from a higher time frame setup. My risk is a bit wider, but my take profits and my reward is a bit higher. Whereas considered if I was taking an intraday scalp, I could have also taken that on this candle, on this candle, on this candle. And then we're gonna get into the 9th of October. Let's see if my data allows me to go that back. 9 October. 9 October, yes, we could. We could go to the 9th of October, 9 October, 9 October. There we go. 9 October. What do you see on the 9 October? This is the 3-day gap up, Hito, and then we've got this price action. So this is yesterday's low. What do we see? Thumbs down, thumbs down, thumbs down. and I participated in this whole move down, and I took my profit, and I wasn't able to really re-hit because I made a lot of money on that move down, and I wasn't really able to re-hit this level, re-hit this, which is also a learning process for me. But I was able to participate in this. And what do you see? If it was any other day, if I was shorting this, I would probably already be taking some profits out here, some profit out here, some profit out here. I didn't. I held all the way because it's a higher time frame setup for me, you know? And then let me pull up the chart of the 9th of October. You see that on the 9th of October, I had a 5-hour day. That's $1,500 for me. That's a lot. And what do you see? I was already building up into that short in Asian session when the market opened down. And I was already up a bunch. Market went up. And as you can see, I'm holding through pullbacks. I don't worry about this sideways action. I don't worry about what's happening with the time frame. And look at this, the 5 minute. So I held all the way through. I was even asleep. And you could see that I added size here, added more size at open. And I was able to hold through this pullback. Went back up, went back down, and I was covering. And I had a $1,500 day, and gorgeous, absolutely gorgeous day for me. I did very well in October. And you could see that this is a higher time frame setup. It comes from me holding through pullbacks, having a higher time frame plan with a risk respecting those higher time frame plans. And you could see I'm holding through those pullbacks. Whereas if you go to my normal trades, which I could probably show in a bit as well, that I don't usually hold through pullbacks like this. I don't hold through crazy moves like that. But when the setup comes from a higher time frame and I'm able to make a substantial amount of money and I'm able to really get that A plus days in, and I'm striking on it. I make sure that on A plus setups, I make sure that I strike, because days like this barely come by these days. And days like this is where I should be striking and making my money. So very happy how it played out. As you can see, gold short, had some other trades. See, this is an MNQ trade where you can see I took an L on it, a very tiny L. I shorted as it rolled over. Short should have been a bit higher, but then it rolled over, and then usually what you also see in episode 3. So the moment I'm in, the first pullback against me, I'm okay with it. If it rolls over, it does a second pullback, I'm out, because usually it shouldn't be doing that. And you could see we went back down, up, chopping, and then we got the rollover, and then I was already gone. It was already late, and I was already gone. And for the rest, got a nice long cover. But see, this is how I usually trade. This is the 1 minute. I get my base hits in, and these trades do not come from a high time frame setup. I take my trades very small. That's on the same day. But you could see that on this day, on a 5 minute candle, I was holding through pullbacks. And then we could go to the 21st of October, which I also showed. Let's go to the 21st of October, which is 3 gap ups, and then this big day down, which was 17 October, which I remember I traded gold that day as well. And what do you see? 16th of October, 17th of October. What do you see? 10-hour day, $3,000. And then what do you see again? We're again on the 5 minute chart. You see me shorting gold. You see me shorting gold, holding through pullbacks. And I showed you the example that I took on the other days. Let me see if I have maybe, no, I only took one trade that I showed on the other examples where, see, this is another one on the 3 minute. Also very nice trade. But you can see sometimes my trades are like that. As I see it rolling over, I'm out on the 1 minute. So higher time frame, and the whole idea, the whole purpose of me showing you those charts is that higher time frame setups and lower time frame setups are in 2 categories for me. So whenever I talk about a high time frame setup, I'm okay with holding through pullbacks. I'm okay with recycling shares. I'm okay with having that fixed buys and longing, or shorting, covering or reshorting. And that's because I have a higher time frame bias. I have a higher time frame plan for it. And on other setup, the lower time frame, which I showed in the slide, I have lower time frame plans for them, and I don't hold through pullbacks. I'm trying to hit my base. I'm trying to hit my scalps. And as you can see here as well, 5 minute, I short, rolls over. One thing which is very nice is my entries are so good that I barely go into drawdown. So I'm very proud of this trade. No drawdown, which is phenomenal. And I was in with quite a big size. So you see it dumping down, and I'm not taking any out. You see it dumping down again, I'm not taking anything out. You see it rolling over, I'm not taking anything out. So every dump we get, I'm not taking anything out up until the market opened, gave us the initial dump, took some out, took some more out, and took everything out at the lows. And this is how you handle higher time frame setups. And then we're going to go into the 21st of October, where we got that massive sell-over. I don't remember if I traded this though, 21st of October. 22 October, 21. And you can see back-to-back PR days, gorgeous. 21, I did trade it. 21, October 13-hour day, which is around $4,900 for me. And once again, I really capitalized on that gold trend down, which I showed on the daily that I was able to participate on that. And how I was able to participate on that comes in episode 3. So I'll be showing you exactly the same setups again, and I'll go over why I took the entry there, what I saw, and why I was so bearish on it. And we're going to go over that in episode 3. But for now, what I'm trying to explain is the difference between that higher time frame and lower time frame setup. So you can see again, 21 October, 13-hour day. And you can see I'm shorting on the 3-minute and I'm holding through pullbacks. Well, this went all the way down more, but I think I was not trusting it anymore, whatever. But still, regardless, nice. It pulls back, it comes down, and I'm like, okay, you know what? I'm happy with the profits. And you could see I shorted a bit more. I shorted it twice. So I also have it here. Yeah, shorted it twice, and you could see on the pull, on the push back up, shorted it again. And in general, I just made a lot of money and I'm very happy. And even said plan of the day, full focus on gold, immense weakness. I see 0 buyers, need a nice pop. See how sustainable those pop are. Ideally pop into view up, pop into yesterday's low. If there, we'll take a heavy size trade. And it perfectly did that. As you can see on 21 October, it popped down. There were 0 buyers, which I also stated on that. 0 buyers. And then what happened is we got a pop into view up. Shorted it, covered, re-shorted here, covered. And ideally, I wanted to pull back to these levels, but that's way too high. And seeing that there are no buyers, I was happy with the view up pop. And this kind of shows that the difference between higher time frame setups and lower time frame setups. And I think being able to show that on gold was very well. And we can go also to NVIDIA. I could open the daily chart, and I remember that on the 25th of November, which was just recently, 2 days ago, we were very short, so we were watching NVIDIA break these levels, and I can turn on the lines again, shows better, and this is the day, 25 of November, 21 November, 25 November was the day that we took the short. You could see that we're watching this key level break down. What do you see when we go back to the 25 November? We break those key levels that we're watching, this level and this key level. What do? It breaks down, we short here, and then we get our money in. And then because of this, I was also able, multi-asset analysis, I was able to take short MNQ and made nice money on that. But then we're going to get over that in episode 3. And so that's the difference between high time frame setup and lower time frame setup. I'm trying to see if I have something for... so this is more about the support and resistance or key levels that I kept on mentioning in the slides. And now I'll show you something for what I mean with react, don't predict. So 29 October, 4th trade is what I have on my journal on the QQQ. So we're going to go back to QQQ, 29 October. Let's go to 29 October, 29 October, 29. Oh, this is 29 October. On 29 October, I remember I was bearish here. I was very bearish. I wanted to fill off pre-market high. We had a massive gap up. I wanted to fill off pre-market high and then roll over the short. What you will see me doing is that I'm reacting to that level. So when it popped here initially, I didn't even short this or this. I shorted once it rolled over. Once it confirmed that it wants to do the filled breakout. Once it confirmed that it wants to roll over. That's where I entered. And I think it will be a very good case study for you to see that how I handled 29 of October. 29 of October. You could see 29 of October. Kind of sucks. I was right on the day, but still a good example. I remember I was very bearish for that then. I kept on shorting, but 29 October. Let's see the 4th trade. This is the 4th trade, and then we have this version where I took a screenshot. This is the full version. So what you could see, as I showed you guys, I didn't short here. I didn't short here. I didn't short here. I didn't short here. It went higher, and I was like, okay, this is a reason why I react and I don't predict. Yes, my prediction is that it should fill those levels. We're gapping up. We're coming to this pre-market highs. We should be failing those levels. The market was already overextended. So in my bias, I was short. But just because I'm short, I'm not going to be touching short. I'm not going to be selling every time it comes back to these levels, because this would have been a substantial loss. 3/10, you could have taken a 25-point loss. 25-point loss is that's money. So what do? I wait for it to roll over. It rolls over, I short. And then I catch my 40-50 point move. And then I catch my money move. And then I make my money. It's because I'm reacting and I'm not predicting. And I think it's a very good example, like being able to show you to show this to you guys. It's a very, 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 very nice example. And then I think, as I said, don't really worry about if you don't understand. I even took these short. It was also a very nice rollover. But I think what I'm trying to explain is how I use higher time frame levels in comparison to my intraday levels, and what the difference is between high time frame setup and lower time frame setups. So the lower time frame setup, they come from quick scalps. They come from within intraday. So this is a bit of a more high time frame setup. The gold was a more high time frame setup. This is a high time frame, and then you've got those intraday key level setups, which is like this. Like, yeah, it fills VWAP on these levels. It fills VWAP. You take a short, you make your 10, 20 points, 30 points, or whatever. Same with here. It fills VWAP. You take that 10, 20, 30 points. And I'm not holding through pullbacks. I'm not holding for it all the way to come back down and up. And I don't know what. And I remember this was FOMC. But I'm not holding everything all the way back down. So this is the difference between high time frame setups, lower time frame setups, and the difference between me predicting to the market or me reacting to the market and not predicting. And yeah, so that's it for that. Then we're gonna go to how to find key levels. I'm not gonna go too in detail about that. As I said, episode 3, I'm gonna go in detail about that, but most price levels are irrelevant. The key levels are where the market previously showed strong reactions, big pushes up or big rejections down. And that could be called, once again, liquidity levels, supply and demand, anything you want to call it. And everybody uses different names for it, but for me, I just call them key levels. I call them high time frame key levels, previous day high and low. That short that I showed you on the MAQ, the very last short, that's a previous day high low filled breakout. And then you've got pre-market high low. It was a pre-market high low breakout, and the Nvidia short that I showed you was a previous day high low breakout. So pre-market high low, psychological levels, which you usually use in equities, or we also use in the NQ. So 25,100, 25,200, 25,000 itself, 26,000, 27,000, 26,500. Those whole numbers they're interesting institutional levels. You sometimes see a reaction on them. Do I use them rigorously? No, I don't. But do I have my mind to them when we do approach a very psychological level, like the 26,000 on the NQ or the 26,500 whole numbers, round numbers? I do have that in the back of my head. So we're gonna get into intraday key levels plus VWAP, EMA, ETC. What are these indicators? So intraday key levels are intraday levels that are completely irrelevant to the outside market. And what I mean with the outside market, they're completely irrelevant to yesterday and the day after. So what happened? So this key level that I have marked right here, this break of VWAP, and then this short, this key level is completely irrelevant to these levels here. Completely irrelevant. The only relevant levels for, if you consider yesterday's price action, is the high, low, open, close. Those 4 things are the only relevancy of yesterday's key levels, and they're the only yesterday key levels I use. When I'm talking about intraday levels, so let's say if we go back to today's yesterday's intraday level, the only levels that matter are pre-market highs, pre-market lows, yesterday's VWAP, and that's it. So for yesterday's key levels, open, high, low, close. For today's key levels, pre-market high, pre-market low, and obviously the high, low of the day and the open and close of the day, and yesterday's VWAP. And then you've got this is yesterday's VWAP, by the way. A lot of people don't use that. I use that, and I've done phenomenally well with it. And it kind of shows that I come from an equities background, and those are equity strategies that work phenomenally when they come in handy. You know, they're not there every day, and that's why they're in my playbook, but I don't trade them every day because they don't happen every day. But if they do happen and I like it, I take them. Simple as that. And then what do you see? I have 1, 2, 3, 4, 5, 6 indicators. The EMA 200, the EMA 20, the EMA 50, my bad, the EMA 20, the yellow line EMA 13, the purple line EMA 9. Do I use the EMA 9, 20, 50, 200? Sometimes. I don't use them always. I don't use them rigorously. But if we're in a bullish market like yesterday, And I'm trying to find where we could have a dynamic support where the price would dynamically be able to hold up. Then I'm interested in it. Gives me conviction that, okay, we could see a quick bounce here. I could get a quick scalp in. The EMA 13, most used along with my 3-minute chart. It helps me identify strength, reversals, and confirmation of reversals. I'm going to get into other confirmations within the price action like high, low, low, high in the coming episodes. But for the indicators, I want to cover them now. So when I later talk about them more often, then you already are familiar with how I use them and everything. The EMA 13, if I'm taking a reversal trade, let's say, and the market is going, let's find a good example. Find a good example. Yeah, this could be a good example. So when the market is going up, what I usually do before I catch a reversal trade, I want the EMAs to catch up. I want the EMAs to be hugging the price action, to be hugging the candlesticks. This gives me a good indication that the average exponential price we're now stacking up. We're not overextended, we're not down extended, we're consolidating. And this, if I want to take a short, gives me a higher chance that the short for the reversal will work. And that could be the same for bearish, for bullishness. So I remember even this trade, I took this trade on the 21 November and I gave the same exact reasoning on live stream. So we went down and then I even said I want the EMAs to catch up. So I remember that Sheikh M, the guy next to me, he took the longs here, but then we rolled over and he got a nice scalp out of it. But for me, I didn't take it. I said, I want the EMAs to catch up. So we came back down here and I didn't long this. I was like, I want the EMAs to catch up. So I saw that the EMAs were catching up. The candlesticks were chopping within the EMAs. And then we got this massive move. I took my entry and I took everything out here. Quick little scalp. Nice. This thing ran all the way up. Didn't expect that. But this is how I use EMAs. I use them for reversals. So once it breaks it, not only just breaking it like that once, but it has to really consolidate around that EMA and then break it, gives me a confirmation for a reversal. I'm not taking a trade based on that. I'm not entering based on that. It's a confirmation. It's a tool I use to help me identify that, yes, we are consolidating and yes, the breakout or the reversal is really coming. 2, how you could use it. I use them as a dynamic support, as I said, for the other example that we had here. I use them for a dynamic support. You could see a dynamic support. You could see a dynamic support, dynamic resistance. And do they always work? No, but I use them as dynamic support and resistance. I use them as a key of, if I'm short here and it goes down and it goes down, I know that I don't want anything to do with that short anymore the moment we break the EMA 13. I don't want to be in there anymore. I don't care if it rolls over that, but I just know based on my edge and my probability that I shouldn't be there anymore. So it also helps me with my exits. So what do we have now? It helps me with my exits. It helps me with confirmation of reversals. It helps me know when it's following the trend. And as you could see, we're following the trend. We never break it. We're following the trend. So which could be used as an exit strategy. And those are really the 3 key things that I use for the EMAs for. And I've been using them since I ever started trading, and I don't know why I specifically use the 13, but I'm used to having my charts, whether you use the EMA 9, 10, 11, 12, 13, 15, 16, it doesn't really matter. They're always going to be around those levels. I don't use EMA crossovers or all that nonsense, but just a nice confirmation for me. And then what do we have then? We have the VWAP. The only indicator I swear by. I use the indicator every day and I count without my VWAPs. That's a strong, thick blue line. I use the VWAP, that's a volume weighted average price. That's the average price of the session. It gives me a good indication whether we're strong, bullish, bearish, weak. Helps me see dynamic support and resistance just like the EMAs, but this is something I use heavily. So if we go back to price action from yesterday, you could see we shorted these levels here. Why did I short this? Why did I short here? Why did I short here? We fill VWAP. We pull back into VWAP. We pull back into pre-market high. And remember, pre-market highs, intraday pre-market highs, they're key levels. We roll over from VWAP. And yes, what I want to see is a deeper fade down. We don't get it, but we take our short and the short is gorgeous. And this is how I use VWAP. I use it as dynamic support and resistance. Once we reclaim VWAP, as you can see, we pull back down. I was short here. We pull back down, reclaim VWAP, and I'm all out. Why? Because I know it reclaims VWAP. I don't want to have anything to do with there. I don't have any business shorting that when it's above VWAP again. So this is how I use VWAP, EMA 13, pre-market highs, pre-market lows. I have a specific video already on my YouTube about pre-market high, pre-market lows, and I'll get into them in a single second. Let me just see what else there was. So we're going to go to higher time frame. Already discussed higher time frames. I use it to get my biases. When I look at the higher time frame on the QQQ, I look at highs, lows, open, close, and specifically the high and the low. What I always tell myself, if we're close to breaking the highs, I have a bullish bias. Bullish bias. Bullish bias. If we're close to breaking the lows, I have a bearish bias. If we're gapping up, depending on context, in a gap up, I want it either to dip back down, so I buy the dip all the way back up, or I want it to pop at market open and I short it back down. If it gaps down, I want it to dip back down, long it back up, or I want a massive pop so I can short it back down. Remember those two things, very important. And for this example, I don't have charts for it, examples for it, because I'm gonna go very in detail, very in depth about gap up setups for episode 3. Gap ups. Let me even write it before I forget. Yes. And then we've got, let's go back to previous day high low. As I explained earlier, how I use my previous day high low. I take trades based on the previous day high low. So if I see that price is, let's say, there was a very nice example on SPY the other day. Let's go back to SPY. Where was it? Where was it? Oops. Where was it? Where was it? Where was it? Where was it? There we go. The 21 November high and 25 November. What do you see? Very easy. We see this level. This is yesterday key level, what I call. Yesterday's high level is what I call. What do I see? I see a bounce off of yesterday's key level. And we never go back down. And I've got way more examples. This is yesterday's high. Once we break yesterday, we fail it, we come back up, and we just go up. So it kind of shows that how important yesterday high and yesterday lows are for me. And I have some more trades about where I took shorts. Another trade, breaks yesterday's low, pops, fills, and we short this, and we did that on the QQQ as well, which was this day. Let me see which day it was. There we go. There was this day. We fill yesterday low, pop into it. I short below VWAP, and we got a massive, 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 massive trade. And I'll go over this all when it comes to episode 3, where I go and show you exactly for every specific setup. I have 20, 30 chart press setup already ready for all of those, which I can then go in detail about, explain my trade, how I do the trade, why I do the trade, etc., etc., etc. And then we've got psychological levels, already explained that. Intraday key levels, already explained that. Those are key levels that are only relevant for the day. And I could show that example here again. So we go up, down, up, down, up, down, reclaim EMA. Let's say you long this, you make a nice scalp, that's it. This level that I took a long on is completely irrelevant for the next coming days. Intraday key level, keep that in mind as well. Especially on my streams, I talk about intraday key levels a lot. I talk about yesterday high and yesterday low a lot. I talk about pre-market high and pre-market low a lot. Keep that in mind. Yesterday key level, they're only relevant for today. They're not relevant tomorrow. They don't have any relevancy for the day before. Only for today. And you will never see me based on intraday key level hold for a multi-day banger mover of 10 or 15 hour trade. You'll never see me do that. All my big trades, they come from higher time frame analysis. They come from levels from yesterday, from yesterday's VWAP, yesterday's high, yesterday's lows, whatever it could be. And, oops, sorry. And then what else do we have? 13 November have I written down. 13th of November. 13th of November, 13th of November. There you go. Quick little example. I already went over it with this example here, but what do we see? Those yesterday's key level. We break yesterday's key level. We fail it, pop back into it, and we short it back down. And, you know, for the sake of simplicity, I think we should go over my trades on that day. And then I'm going to also show you for some equities to show you that this is multi-asset, that this, whatever I'm doing, works for everything. We're going to go over the master chart. We're going to go over NVIDIA and Tesla charts. And then I'm going to show you what the difference is between inside day and ranging day, which we already spoke about before, but I'm going to show you also a real life example of it. And one thing which you should realize is that pre-market, so before the market even opens, I already know what I'm looking at. I already have my levels in mind. I already have my bias in mind, and I know that I'm looking for something. So for instance, on this day, before the market opened, I already knew we're very close to breaking yesterday's low. So I'm already bearish on the day. So I'm not gonna be looking for longs if I see this reclaim here. I'm not gonna be longing this. Why would I be longing this when I have a bearish bias? No, I try to position myself for shorts. I try to find where shorts are relevant for me. And then you could see it goes down. I'm not interested in trading this. I'm not interested in trading this. No, I'm interested in shorting this. I'm interested in continuing shorting this. I don't care about the longs that present themselves. Every market, whether in a bearish market like this or a bullish market like this, you'll always be able to get counter trends. But what I always tell myself, counter trends, when you take them, this is also in another episode that I'm already going to talk about because I don't want to gatekeep you. I just want to give out so much value. Counter trends, they're scalping trend. They're scalping trades. If I'm in a counter trend, I will not be holding through pullbacks. Never. I go break even, stop loss at break even. I can nearly say instantly. I trail my stop loss nearly instantly. I take whatever it gives me. Does it give me 10 points? I take my 10 points. Does it give me 20 points? I take my 20 points. Never, ever go into a trade where you're going against counter trend, where you already make it difficult for yourself and also thinking, okay, you know what? Let's hope it dies now and it just reverses. Doesn't work that way. Don't ever do that. Even if I take a counter trend trade, you'll see I go stop loss, break even instantly, and I just scalp it. I take whatever it gives me. And then we're gonna have, I'm gonna open the chart of this 13th of November, and I'm gonna show you an inside day, the difference between an inside day and an outside day. Let's say when price opened up here, I knew it was going to be an inside day. We went up, we went down, went up, never broke highs, never broke. I just knew we're in a massive push up, another push up, and then inside day. Why is the inside day? We're within that range of yesterday's high and yesterday's low. We gap down. Once again, I knew nothing significant was going to happen. Yes, nice sell over because we've had this massive push up, but I knew nothing significant was going to happen because we're still within that inside. We're still within that yesterday high and yesterday low. Then what do you have? 12th November breaks yesterday low. I knew this is not going to be an inside day. I knew it was going to be a nice trending day. It's going to be a now downtrend day, and I capitalized on that. And like earlier shown in the beginning, showing chart, some trades simply just quick. Yeah, so I also went over that already. Some trades are just quickly scalps. They come from intraday analysis. Some trades there I hold for bigger moves because they come from a high time frame analysis. And then the 13th of November. Let's go over our chart of the 13th of November. 13th of November, $2,000 day. And it kind of shows that, I don't know what to say. It kind of shows that on days where the market just behaves the way that I want, I make a lot of money. But you could see, what did I do? Market opens, 2:30. That was during winter saving time. 2:30, market opens. We short, cover. Market pops up, and I'm already in a short, cover for M2K. And the third trade ended up as a break even. I shorted this, which is this area here. I shorted this, and then got out break even, which is okay. And then I reshorted the top and caught a 150 point move. I don't know what it is. 150 point move, something like that. For here, 100, nearly 180 point move. Nearly a 200 point banger. And what do you see? Pull back into yesterday's high, yesterday's low. We have a higher time frame bias. So yes, this looks like an uptrend, But higher time frame is already telling me something else. So what did I do? I shorted it. And once it broke VWAP, once it broke the EMA, I was just sitting back, relaxing. And I was like, okay, this trade is going to pay me. And oh boy, it did pay me. And you could see, we just rolled over all the way. So I think it's nice to be able to like really show that when I'm talking about those trades and I'm talking about the theory behind it, that I'm able to show you guys charts of real trades that I took and my real execution and everything. So yeah, very nice trade. And happy about it. And then we're going to go into what I wanted to show was also that this also works for multi-time frame, multi-assets. So MSTR, you could see we're on the daily. This key level here, I shorted this here, took everything out here on my equities, on my portfolio, but you could see this thing just already died all the way. I could go open tests. Let's open something a bit easier. Let's open RGTI. RGTI, when RGTI had that massive, the quantum index had a massive bump, and this is completely irrelevant for people that are trading futures. The only reason I'm showing this is to show you guys that daily time frames and high time frames really are the reason that you're able to catch big moves, and intraday time frames, intraday key level, they're able to give you small scalps base hits. As you can see, what do we see? We break these highs. We never inside day, and that day that we do break that yesterday's high, we have a massive push, and from there we just never look back. And the same with that as well. We never really get into breaking yesterday's low, never. And then what do you see? The moment we break yesterday's low, we have that massive rollover. That's where the trend bearishness starts. You could see that all these moves, we never broke yesterday's low. And please keep that in mind. Daily, yesterday's low, daily candles, yesterday low and yesterday high, one of the most important levels. One of the most important, and I use them every day. So if you're following my streams, if you're following the way I trade, then keep in mind, daily key levels, very important. And yeah, so the aim is out showing you guys that this also works for other equities, for other instruments, for other things. It worked for gold. It worked for the QQQ, which is the MNQ. It worked for equities. So, you know, this is just a one size fits all. It's a price action method of reading. You know, I'm reading price action, I'm reading volume, I'm reading everything by only looking at this. And, you know, I'm not looking at fair value gaps. Oh, this is that, or this is that, or liquidity high there, or I don't even know whatever they use. You know, I use real price action, real levels, and you could see they work. And I showed you my trade, I showed you my executions. And this is just the foundation. I'm not even going in depth about it. I'm pretty sure you'll be amazed by the time episode 3 comes. Yeah. Let's see what else I have. And yeah, then we have risk management and everything, but then I think I don't want to give you guys too much about risk management either. That's going to come in the later sessions as well. But yeah, there was the 13th of November. Very nice day. Where is it? I forgot to post 12. Yeah, 13th of November. Very nice trade. And I show you guys that this comes from a high time frame setup. And then we're going to go to the continuation of this. So we explained what VWAPs and EMAs are. We explained those key levels. We explained psychological normal. We explained pre-market high and low. Showed charts for them. Explained previous day high and low. And explained high time frames. Time frame hierarchy. What time frames do I use specifically? Trading without time frame awareness is like driving blind. Each time frame tells a different part of the story. Your edge comes from aligning them correctly. Just like how I do with the daily and the 3 minute and the 1 minute. Daily and the hourly. The bias. I get my bias from the daily. As I showed you guys, I'll be doing in-depth episode. Probably episode 3.1 is going to be a whole about how I get my bias. But daily and hourly, I get my bias through that. I get my bias based on yesterday's close, on how yesterday's open high were, about how yesterday's close, about how yesterday's open was, about where yesterday's VWAP is. I get my bias from that. That gives me the contextual, bigger picture of what's going to happen in the next day. And once again, I'm not predicting. I react to it. If it happens and it aligns with my plan, then I do get a trade. And then I put my trade, and whatever happens is on the market. If market doesn't want to work, then I make sure that my risk is tight and my risk is in check, and then I lose on that trade. Happens. But I have a daily bias. I come into the day with a bias, and some days you don't have a bias, and that's completely normal as well. Plenty of days where I just don't know what the bias is, and you know, I just come in with a neutral mindset. I'm like, whatever it gives, even if I get a quick scalp in. high time frame defined direction. Are we in an uptrend, downtrend, or range? As I explained, are we going to be an inside day? Are we going to be in a downtrend day? Do we break yesterday's lows and have a massive sell over? Or do we break yesterday's high and have a massive push up? And this is your compass. Never fight the daily chart. Once again, I could show it. We're on RGTI. We break the daily high. And we break the daily high. We go all the way. We break the yesterday low. We go all the way down. And then on days like this where yesterday's high and yesterday's low are not being able to be broken, those are inside days. And then we get the rollover. We break the yesterday low and then we roll over all the way. Same with the QQQ. Same for anything. As you can see, for this ugly inside day for this candle, but then on days where we do break the highs, this is what we get. And then this was supposed to be inside day ugly price action as well. Yes, it looks nice here, but intraday looks very ugly. And then you could see once we broke the yesterday's high, we get very nice price action and we have an uptrend. 3 minute, you could already see that I use the 3 minute nearly every time. I recognize my setups from the 3 minute. I recognize my patterns from the 3 minute. I beg you to also use the 3 minute or anything higher. 5 minutes is also good. Use your 1 minute solely for your entries. 3 minute, the setup. Lower time frames reveal trade opportunities within the bias. Here you find patterns, breakouts, and structures that align with the bigger picture. 1 minute, the trigger. Super low time frames provide position. They give me the accuracy, the 1 minute bar by bar entry, the 1 minute bar by bar exit, which I will go in depth about it as well. Use them only for exact entry timing. I'll show an example though, just so I don't gatekeep you guys. One candle here means nothing without context above. So what I mean with this is you cannot blindly just look at the 1 minute chart like this. Look at the 1 minute chart like this and be like, let me find a good example. Like this candle here, this candle here. Look at this and be like, oh, this is a hammer candle. We're going to go up. We're going to shoot up. And then you get this massive sell over. A 1 minute candle on itself is nothing. A 3 minute candle on itself is nothing. It's a collection of candles. It's a collection of your bias that gives the trade, that gives you the idea, that gives the patterns, and that gives you the ability to take a trade. So don't get fooled with that. Very important to talk about that. And then top-down analysis. Obviously, what I do, as I said, I have my bias from a higher time frame and I work my way to lower time frames. And that is how you should technically approach it. It helps telling you whether you hold for home runs or you hit for base hits. And once again, the higher time frames, they allow me to hold for home runs. The lower time frames, when I take a trade that doesn't have anything to do with a high time frame. So when I take a perfect example, genuinely perfect example. Let's go back to the 3 minute. A short that we took as well was this one. We go up, reclaim view up. So the short we took was this on stream, went down, took another short here, went down, and then I took some out and the rest break even, and then reshorted this, took an L forward as a reclaim view up. Those were all the trades. And then it reclaimed view up, went all the way up. And then look, do you see this inverse hammer? This inverse hammer on a day where we had a massive gap up and we have a massive overextension, it's okay to be taking that quick counter trend trade based on that single candle alone. But it would be a lie if I said this is only based on this single candle. This is contextually based on the fact that we gapped up. Google was about to break yesterday's low. Nvidia was weak. Tesla was weak. Keep that in mind. Keep that in mind. I'll show you Google's charts in a bit. I took a short because this, if someone from the outside looks at it, they're like, yeah, only because you see an inverse hammer, you took this short. Sure. I took it, yes, solely because it gave that inverse hammer. But the context aligned with it so much that I couldn't not take it, that I had to take it. And this triggered my entry. This time frame pattern, that only time frame, that candlestick, that 3 minute candlestick, gave me the reason, gave me the courage to take that trade. If it didn't happen, I wouldn't have taken it. So in specific cases, as I said here, you could hit base hits based on smaller time frames, and that's not only for one candle, but even if you take a quick VWAP reclaim like that and you take a nice long, this has nothing to do with high time frame analysis. This is just a quick break this key level here, holds VWAP, breaks pre-market high, and then we get a nice trade up. And this is specifically because of an intraday setup. Tomorrow, this key level and this setups or whatever is completely irrelevant. And this is just a quick base hit. Whereas if you take a trade from a high time frame, just like I showed on the gold and on the other ones, you're really able to stretch it down and hold it for bigger moves. Let me show you the Google, what I meant with this chart. Let me show you the Google chart. Let's do it. Oops. Let's do it on this so I don't lose anything. Google. So what do you see? What do you consistently see? What did I show you? What did I also explain based on yesterday's low? What do I see? You can't blame me. Yes, we never broke yesterday's low. Market still held up. But I know that I come into the day very bearish for Google. And knowing that Google has been leading the market along with NVIDIA, you can't blame me for, and I'm watching NVIDIA being weak. I'm watching it bounce back and never being able to break highs. And every time I'm watching it reclaim VWAP and chopping up. And in my mind, I was like, okay, there are no buyers. And unfortunately, there were no sellers on that day either. But this could have just tumbled all the way down. Google could have tumbled all the way down. And I could have caught a massive continuation short. And you could see Google just filled every time it wants to, every time it tried, it just doesn't want to do it. Reclaimed, but it never broke VWAP until end of day, but it never really broke VWAP. So you could see that my idea of Google being bearish and my idea of Google being weak is right. It just, unfortunately, even though Google has been leading the NQ and NVIDIA has been leading the NQ and they both were weak, I never was really able to get that massive sell that I was looking back into VWAP, that massive acceleration into here. And it sucks because you could see it reclaimed and I was only able to take some out here and then I got out break even for the rest. But it's a quick scalp and I'm happy with it. And it might just also accelerate and continue all the way back down, which I've seen a million times happen as well. So smaller time frames sometimes do give you a good, nice, quick scalp, quick, nice setup if the context is right, if the context aligns. So yeah. This is it about the daily, hourly, the buy, the 3 minute, the setup, how you do the 3 minute and everything. Get over it in episode 3 way more. Show you the setups and everything. And then you've got the 1 minute. Let me see if I can find a quick example of what I mean with the 1 minute as well that I use for my entry. The 1 minute is very important. What do you see here? Why did I take an entry here? The 1 minute bar by bar. Precision. Perfect entry. Perfect entry. I'm in here. I'm risking these lows. Trade works out perfectly. And this is what I mean with let's see if I have some more. Let's see if I have some more that comes from a higher time frame. What do you see here again? Perfect example. Happy that I see this. What is this? This massive move up. Counter trend. What do I do in a counter trend? I take my short. 1 minute bar by bar. Perfect entry. What do you see? The moment I see bits stacking up in the order on the DOM. The moment I see in the order book bits are stacking up, the moment I see it being soaked up, every time we get a pump down, it gets soaked up, I go out. I even make some money off it. I would also take it out break even. I wouldn't mind. But you could see I'm out. Counter trend trade. I have no reason to be in there. And then you could see I re-hit it that day. Where is it? See? This is where I took the initial short and then it rolled over and then I tried it again. And then you could see I'm risking higher day. And then we did this time get the nice rollover. Does this have anything to do with the higher time frame? No, it's a counter trend trade. The higher time frame is telling us that the market is bullish. I took a short setup. In my mind, on such an overextension, a quick intraday scalp, I will be shorting this. It's a quick intraday. It's a base hit that I'm taking. And this is why you could see I'm out. Because I know this is usually falls under a base hit trade. And I take my base hit and I'm happy with whatever I made. I made like 60, 70 points, or 70 points. I made 70 points of that. I'm happy with it. If this came from a higher time frame setup, I bet you I would have held this all the way for a 200 point drop. But it didn't. This could have also just continued going back up considering the amazing strength that we had. So it's always good like me to have a plan. Let's put it that way. Very nice day as well. $756, just 2.5 hour day for me. Very happy. That was last week. But yeah. Candlesticks. Context is everything. A single candlestick means absolutely nothing in isolation. Beginners obsess over doji candles and hammers. Professionals ignore them unless they appear at a level where they're already hunting for a setup. Just like I showed you. Do not be fooled by a single candlestick. A single candlestick doesn't tell you anything. Don't get fooled with it. Don't get blinded by it. And as I showed you in the previous examples on how sometimes they come in handy when you look at that single candlesticks, but you already are hunting for a setup because contextually everything makes sense for me to go short. And this is why I use that single hammer, inverse hammer, as an entry model. And kind of nice that I spoke about it before. But yeah, the trap Candlestick patterns fail constantly because traders apply them without context. I had a context. I explained my context. And that's why I applied it. A hammer at random is noise. And I showed you that 1 minute example. A hammer at random, literally completely noise. A hammer at major support with volume tells you a story. That's a signal. That's a signal that this might be something significant. The reality, candlesticks only matter when you're already waiting at the predetermined level with a plan. They're confirmation, not prophecy. The edge, inverse hammers, dojis, etc., etc., etc. Use these to your advantage. This will help you get sniper entries, just like I showed you. Help you get really good entries. And I'm just randomly skimming through them, but I have millions of examples where you could see we go up, 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 1 minute bar by bar. I take my trade, first pullback against me, which I said it's okay. If it reclaimed and went against me again, I would have gone out. And you could see massive rollover. I take an entry at around 270s, and this goes to 280s. I have a 10-point loss, a 10-point risk that it went against me, 10 points MAE, and you could see I make 175, or I make around 200. Fair. I made 70 points, only being in drawn of 20 points. Gorgeous. And see, once again, what do you see? I add starter size because I know I want longs. Add more on the confirmation that it breaks the 1 minute bar by bar. As it rolls over, I'm like, okay, I see sellers, I don't see buyers coming in, and then I take out everything break even. And kind of, it's very nice. Like, it's very nice to be able to show this in real life, in like that I really took these trades with my own setups. And you could see here again, it's normal. It could fill. I take my 1 minute bar by bar. I take my entry. It rolls over. I take it. I take an L on it. Can't do much about it. It's part of the game. You know, not everything is gonna work every time. And yeah, so this is how I use the 1 minute with respect to the 3 minute setup. So those are all on the 1 minute. I take my entry on the 1 minute, but they come from a 3 minute time frame setup if they're intradays, and they come from a higher time frame setup if they're high time frame setups that I hold for home runs. Trade management. Entry is easy. Management separates winners from losers. Your ability to handle both winning and losing trade determines your survival in this game. Trade management is as crucial as your entry. We could all have the same entry. Literally. You, me, the guys next to me, the guys watching at home. We could all go long at a specific price. But we're all going to have different results. You might make more than me. He might make more than me. The other guys watching this might make more than me. I might just hit a single base hit, 2R. You might make 3R. You might make 2.2R. Being in a trade, entering trade, and that management that comes with it is nearly more important than the entry itself. I think I could say it's nearly more important. When I enter a trade and it goes against me, you might take your full stop loss. I might not. Let me explain what I mean with that. Let's say I want to go on the 1 minute cleaner. Perfect example. So let's say I go short here. This is where I go short. I take everything out here. That was the example that I just showed you. I short here, take everything out here. Yeah, it is what it is. What some could be doing, they short here and they get out immediately at view up. That's another way of trade management. What I know that some do, they only add small size. Guess here, they're out. They were only in with small size because they never got the confirmation that it would continue. Fair. What I also know that some people do, they short here. Goes against them. They're short with 4 contracts, let's say. Goes against them, they take 2 out here. Goes all the way here, they take the other 2 out here. Yes, they took in general a bigger loss. But remember that in certain cases doing that is gonna give you higher expected value. They're gonna give you higher R's in general. Let me also show you an example of what I mean with taking partial stop losses. So a lot of people are familiar with taking partials when they're in a trade. So when you're long, let's say you're long here, you take partials here, you take partials here, you take partials here, you take partials here. A lot of people know about that. But a lot of people, they take their W's with partials, but when they have an L, they take them with full size. So this is your stop loss, this is your entry. You take partials here, partials here, partials here. It's okay, it's a nice trade. In general, yes, this went all the way here, but you never made this all the way here with full size. So you just made a 1.5R trade, considering the risk here. So what you could be doing, you could be trailing your stop loss. You could be using the exit strategies that I will cover in episode 3. The EMA break. Did it ever break the EMA for you to get out? No. Did it close below the EMA? No. Did it ever do a high, low, low, high? What is a high, low, low, high? Where it makes a newer low, a lower low, like this here, like this here. Did it ever do that in this upward trend? No. Did it ever do a failed breakout? So like this, it comes to a key level, pops up, breaks out? No. You could see we went here and we broke it with conviction. If we rolled over, fair for you to get out. I'll get over that in episode 3 as well. Don't worry too much about it for now. But there are different ways to manage a trade which will yield different results. And if you do that every day for every trade for a year, one of us is going to have optimized results. One of us is going to be more efficient in the long run. One of us is going to have way better results. You being more efficient with your exit and optimizing your exit and taking half size L's. So let's say if you're let's say you had a premature entry here and I had a premature entry here, I take my full stop here. You only take 2 contracts out, and if it goes more, you take 2 contracts. But now you have the re-chance to add again. You only took a half size L and then you re-add more, and then it does work. Whereas me, I took a full size L and now I'm in, and you would be making more if we exit at the same place. So understand that over the course of years, you really need to have an optimized exit strategy. You need to be making your winners count. Make sure that your winners hit full size. You hit your TP with full size, so not partial, which I am sometimes a victim to as well. And you need to make sure that a hard stop loss is sometimes also normal to have a soft stop loss, that you take some size out and then you re-add later, or you don't re-add but let the trade work still. So different strategies. A lot of different strategies, that exit strategy and entry strategy, that I'll go over in the coming episode. So when winning, when to move stop loss to break even. You can't just move your stop loss to break even when the trade just works 10 points in your favor. There's got to be a systematic approach to it. Trailing stop loss. You got to trail your stop loss. Leaving runners. Early exits because of fear. When losing, never force the trade. Stop loss stays in place. Accept the loss when your stop is hit. A lot of us have been a victim of having a bias, like back in the day, 5 years ago, on trades like this, especially considering how weak Google was, as I explained. I was short, and then it would go against me, and then I would continue shorting here, continue shorting, and then it fills view up, continue shorting, and then I would blow my account. Accept the loss. If it doesn't work, it's very normal. The market doesn't owe you anything. It doesn't need to do anything for you. Accept your loss. When your stop loss is hit, it's hit. Scaling down also works for losing trades. Cameron Ross, Warrior Trading, one of the best to ever do it. You could look him up on YouTube or whatever. One of the goats within the trading industry. He calls it the trading rehab. When you take a massive L, don't be oversizing. Don't increase your size. Matter of fact, that's what a lot of beginner traders do. They increase size. They increase size thinking that they should make it all back. It doesn't work that way. You took a massive L. Suck it up. Decrease your size. Decrease your size until you made back whatever you lost, and then go back to your normal sizing. That's what you call the trader rehab. Whatever it takes, whatever days it takes, whatever it takes, keep that small sizing. Decrease your size by half. Don't dig the hole deeper. Just take your trade slowly. Half size until you make everything back. Way better. Don't let emotions take over. Very basic things. We've covered that first episodes. Emotions. And yeah, we're going to get into those all in detail. We're going to cover them all in detail on how I use exit strategies. Maybe show some trades. And I'm pretty sure, see, I have certain trades where I'm short. I don't take anything out. I have a wider stop loss risking these highs. And then you could see it rolls over and works. Very frustrating. Let me see. Let me find my L's. I want to find my L's. See, once again, short, exit. I took half size out here. That's exactly what I mentioned. So I'm short here with 6 contracts. I take 3 out here, and then I take the remaining out as I get the conviction that it doesn't want to go. This still gave me somehow a bit of more probability and EV that maybe if it did roll over, just like I showed you that it could roll over, then I'm okay with, still being in. Let's find some other trades that could be, see, and then some days are just like that. Annoying. Very annoying, but I can't do anything about that. As I said, I'm short First pullback, I'm okay, going against me, goes back down, pulls back again, and I'm like, okay, no, this is gonna go, man. This is just gonna fly, and then rolls all the way over. And the trade management is very important. I'm pretty sure if you, the viewer, were taking a trade like this, you would have banked on it probably. But I don't know what was in my headspace at that moment. Annoying, very annoying. And this just comes on how you're managing your trade. Very important to be managing your trade on a very optimized, efficient way. And we're going to go into that in episode 3, how to optimize your risk management, how to make sure that every little trade counts. Even that 0.5 R that you could optimize every day in the course of 250 trading days, which is a year, is already adding up to 100 R. So every R for me is $300 times 100. We're talking about 30 grand. 30 grand that I could just make extra by optimizing my risk management. And then let alone if you could optimize it by 1 R, 1.5 R, or whatever. It really counts. It really, 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 really counts. So we're going to go into that. See if I can find. I have charged for all my broker execution as well, but as you can see here, but I'm using TradeZella because you can't, this is just false. You don't know where I entered. You don't know how I'm managing it. But with TradeZella, when I'm importing my charts, it shows very nice where I take my partials and etc. So yeah, I don't know. See, once again, risk management. It is what it is. I take a short here, goes against me the first time, which is okay. The second time it goes against me, I'm out. Whereas my initial risk was high of day. And then I'm like, okay, it goes against me. This should sure roll over. And if it goes against me, I'm out. And yeah, you can't blame me. You know, this might have as well just gone all the way. But then this shows that I have different risk management and move stop loss to break. I have different approaches and you should as well. You know, like it goes down. I was like, okay, if I get a massive rollover and we break these lows again, so we pull back and break these lows, I'll go stop loss break even. And I never got to that point. It just went immediately against me. So if I was still in and the price came here, I would have already been stop loss break even and I would have got this nice dump down. And yeah, so it really differs. And there are different ways, different approaches to stop loss management. There are different ways for everything. And we're going to get all into that in episode 3. And yeah, the golden rule, your stop loss placement defines your conviction. If you're not willing to lose there, then don't take the trade. So if you're not willing to lose at high of day, just like me, then the trade is not valid. Don't force yourself to take the trade, no matter how much you like it. And then taking trims. Once again, as I spoke about it, scaling out of positions feels safe. You think that, yes, it's kind of crazy psychologically when you're taking a trade, let's say, we're going to show it with a chart. And let's say like me. So when I enter here and I see money here, I'm up a lot of money, I'm up a lot of money, I'm up a lot of money, I'm up a lot of money. I take out here. There should be an approach for you taking things out. You shouldn't exit trades just because it's working and I'm up money. The reason I took things out, the money out, because we were approaching high of day. And I was like, I'm going to take one out of high of day and I'm going to scale more out. And then you could see we rolled over and I still had size. I still wanted it to go higher and then I want that break even. And it sucks because I gave back 50%. I took out 50% here and I gave back 50% break even, which I could have made. But you can't be approaching it with that mindset, that mindset of profit. You can't look at dollars. You should have reasons to exit. Like me, I had a reason to exit here. You know, you gotta have reasons. Same with this. We break highs. I take some out, and then I hold, and then it fills and turns red, and I'm like, okay, I'm gonna be out. And then you could see we roll over. I have reasons to exit, you know? And if it was to me, I also want to stop taking partial sale and take everything out here. It's going to optimize my EV. It's going to optimize my risk to reward in the long run, which I'm also personally working on a lot. But it kind of shows that when you're trading, there are different ways to take exits, different ways to take your partials. Scaling out of position feels safe. Sometimes it's smart, often it kills your edge. As I said, if you every time keep on partialing without any reason, so you partial here, and the trade actually goes all the way to the top, you just gave back so much profit, and this amount of profit, you finally get a winning trade in the markets and make the best out of it, because you got to make sure that this win that you have at least covers another 2 L's, 3 L's that you're going to have. So make sure, just like how you take your stop loss on the low of day, let's say, and you hit it with full size, make sure that your TPs are also hit with full size. I know that a lot of people, they get in shock when the trades work. They're like, oh my God, the trade works, let me take profit. It doesn't work that way. Like, have a plan, take your trades, and make sure that you hold your trades and pay it, because the market doesn't care if you're up $1 million here or if you're up $10 here. Someone could be up $1 million here and he doesn't take it out. Someone could be up $10 million here and they don't care. Numbers shouldn't affect you because you're risking the low of day, which might be a $10 million loss if it hits there. So just like how you're taking your L's with full size, your stop loss with full size, make sure your profits are also with full size. Partials over time diminish your results, but it's okay to pay yourself in certain circumstances because it also saved me a lot of times. And you could see another example. This is stop. I thought it was a, but see another example. Look how much I gave away. Like I shouldn't be exiting here. I shouldn't be exiting here. I should definitely not be exiting here. I should at least hold the first pullback and then scale out. But you could see how much how much more I could have made. So this is what I also meant with just like how we take partials into trades, make sure that it's very okay to also take your stop loss as partials. So let's say I was long here. If price rolled over to these lows, I could have taken half out, and then at low of day, I could have taken everything out. So just like how we're taking partials if the trade works in favor, you should be taking, matter of fact, what I ideally think what people should be doing, what I should be doing as well, no partials when you're in a trade, just full size, full TP. And for your stop loss, you should have partials. And a lot of people don't look at partials for stop losses, which is very important in the long run. Statistically, it's literally proven that you could go and check that you're better off if you are here and with 5 contracts that you take 3 contracts here, or with 6 contracts, you take 3 contracts here off and you take the remaining 3 off here. Like, yes, in general, it's not a lot of difference, but that tiny difference that you're making will compound in the long run. You know, and I don't have anything to show for, which I was hoping I did, but see another example. Sucks. I'm long. I go out break even. You know, because strategically this was a higher time frame setup, and in my mind, the way I trade, this was supposed to go, and it went. You could see this went all the way up, and it just sucks that it took me out break even first and then went all the way. But you could see that I didn't take any partials because I know that this is a high time frame setup and I should have held all the way. And I tried holding all the way, but I also I'm not gonna let the trade ruin me that goes from green to red. I'm just gonna take it out break even, and I have every reason to go out break even. And then it just goes down a bit and then reclaims everything all the way up, which is annoying, but it's part of the game. Can't do much about that. Very nice trade as well. Overall nice trade, long into shorts. Happy about that. Yeah, but yeah, so this is like another thing. See, I buy here, I take full size out here. What I could have also done is take some out as it broke this tiny level here and then take the rest out here, you know, which would have given me, instead of a full 1 RL, it would have given me a nice 0.7 RL. The 0.3 R that I saved will be compounded in the future. Very important. Understanding when to take profit and when to hold is an art that requires brutal honesty with yourself. Ego is gonna kill you. Don't have an ego thinking like, having hope that, but it should go up. It should do this. Nothing should. Nothing is a must. Exit plan. Later defined in detail in episode 3. As I said, my exit plans and entry plans will be defined in detail with charts and everything in episode 3. Number 1, too early. When the trade has barely moved and you're already trimming, you're effectively reducing your expected value, as I spoke about, and as a result, weakening your overall risk-reward profile. In the long run, your overall risk-to-reward profile goes down when you're partialing a lot, especially when you're taking your stop loss with full size and you're taking partials all the way along the way because you're happy seeing money. It's killing you in the long run. Too late. Watching a high R trade go back to your break-even destroys your psychology. Price reverses, your unrealized gains evaporate, and you exit with nothing. You have nothing to show for. You didn't pay yourself. So yes, these two, the too early and too late, contradict themselves. You should find the perfect balance in between them. And that's what I'm also in my journey in finding. And as you can see, sometimes I do take partials, sometimes I don't, depending on the setup. I'm trying to find a balance between that. In drawdown, trimming is often associated with winning trades, but using them on losing trade helps you avoid taking every stop loss at full size. One of the most important things that we have is that be okay in drawdown taking size off. If you know that based on the setup you're seeing that there's a high probability that your stop loss is going to hit with full size, it's okay to decrease size before it hits your full stop. Very, very normal. You're gonna thank yourself in the future. Trust me. Lock yourself out. Important feature, especially when you're trading prop firms. Big wins and big losses both trigger the same response. Irrational behavior. You see big wins, you're like, okay, I made money, lock myself out. Big losses, a lot of people trying to make it back. Lock yourself out. Today ain't your day. Tomorrow's another day. The market is there, 250 days in a year. The solution is simple. Stop trading. After big wins on a big day, you feel ahead and start taking extra risk. Then one loss becomes several and suddenly you're back in the red. After big losses, after a heavily losing day, the instinct is to get back to green the same day. The correct move is to slow down, step away, review what went wrong, and reset for the next day. There are exceptions to this. A+ days. What do I mean with that? I've had times where I've made money on a big A+ day, like that gold trade, and you could see that I had multiple trades. I continued trading. Yes, I made $2,000 on that day, but because I have a clear bias, it's an A+ day, I'm okay continuing trading. I have that extra cushion. I have a $2,000 that, of course, I'm not going to give back everything, but I have $2,000 that even if I risk out of the $2,000, $500 to make more, I'm okay with it. It's an A+ day. I'm trying to make the most out of days like that. So it's okay after big wins, after big days, when you're feeling confident, when you're in the driver's seat, it's okay to be taking more trades when you're still cool-headed. But if the profit is already affecting you, like, oh my God, I made $3,000. Yeah, I'm gonna make 10,000 now. If you're with that mindset, don't lock yourself out. The path forward. These concepts aren't secrets, they're basics. Support and resistance, higher time frames, how I use them, intraday key levels, taking high time frame setups for home runs, taking intraday key levels for small scalps, base hit, VWAP, EMA, how I use them, etc., etc., etc. We covered the basics on what I use on a daily basis. We cover the basics of trading, and anyone that doesn't have any trading experience should be with those 3 episodes that they watch a bit. They should be familiarized with trading, the tools and everything. And now, the path forward. Episode 3. Episode 3 is gonna come. Very excited about episode 3. Episode 3 is in-depth detail, charts, executions, losses, W's, break-evens. You call it, you name it, things you've probably never heard of will be in episode 3. The path forward. These concepts aren't secrets. Every successful trader knows them. The difference is execution, showing up daily, following the plan, managing your psychology, and learning from every trade. Journal, journal, journal. Just as I said in episode 2, journal. And I showed you how I journaled. Go back to episode 2.1. I showed you in the end, somewhere in between, if I remember correctly, how I journal, how rigorously I journaled. I'm not going to go over it again and spend 20 minutes talking about that, but go over it and you'll know what I mean. Show up daily. It's like a business. You got to open your shop every day. If you get customers, you get customers. If you don't, you close up your shop. You know, if you're running a milkshake shop and or a donut shop and one day you don't get customers, doesn't mean you're going to throw out all your donuts. Doesn't mean you're going to get mad. Tomorrow's another day. You close your shop, you're there. You open your shop 9 a.m. in the morning. Part of the plan. Follow your plan. Do your thing. Do your marketing. Do whatever. Every successful trader knows that. It's all in the mindset. So this is it, man. I hope you guys, again, an hour and a half long video. I just seem like I can't seem to shut my mouth. But like, subscribe, comment, join my Discord. I got a lot of positive feedback for episode 1. By the time I posted episode 1 and episode 2.1 will be out, and I'll be recording episode 3. Please leave in the comment section things that I'm doing wrong, things that I could do better, especially for the coming expert, considering that we have 7 episodes to go. So please let me know what I could do better. Please let me know things that you still want me to include. Do you like what you're seeing with the charts? Do you like certain things that I'm doing? Do you dislike certain things that I'm doing? Please let me know in the comment section. Please subscribe. Please join my Discord. I'm there 24/7, hella education there. All my charts that I just showed you on Discord, they're all there. I'm not hiding it from anyone. All my live streams, all my weekly recaps, they're on YouTube. You could go back, review all the trades. I'm reviewing them myself. And that's it. Love. Bye-bye.